Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to We Build Great Apartment Communities, another great episode. I have here Bryan Shimeall, and someone who I think the timing cannot be any better in being on this podcast, joining the show, and communicating with our audience about managing risk, especially in the multifamily space. Habitational risk right now is experiencing some very unique challenges because I don't think anyone really anticipated this risk that we're going through right now with COVID-19, and of course, consequently, very difficult to price, right? So creating some very unique issues. But here's a cool thing. We have someone who is an expert here that deals predominantly, likely 90% of his time and his team's time is spent on multifamily assets, right? And mitigating risk associated with multifamily assets. I am your host, John Brackett. Bryan, welcome to the show.
Thanks, John. I'm excited to be here.
Awesome. Okay, so you and I got into a little discussion prior about habitational risk and some of the unique challenges right now that are being that operators right now are running into because of the market that we're in. So can you talk a little bit about that?
Yeah, absolutely. I mean, it's a crazy time in the marketplace. I think you got to understand almost historically, what's happened, over the last, few years. And, this thing has transitioned pretty quickly from a soft market to what we now call a hard market. COVID was just kind of another factor that layered into the hard market. I think for so many years, for the past 5 years or so, somebody would be looking at an acquisition and they would just look at the OM and they would take the seller's numbers and figure that was their insurance number. And, although we preached against it and said, not a good idea, everybody's, insurance program is different. But between you and me, I mean, for the most part, it probably was a pretty decent guide through a soft market. But, about last year, the rates started kind of heading up a little bit, and then they rapidly really started escalating, here over the past 6 or 8 months, almost at a level that people haven't seen before. And, really what's occurring with it is that not only are prices going up, but underwriters are actually underwriting the deals. I mean, they're looking at these with such a fine level of detail, the age of the building, the losses, the wiring, the roof ages, and at the same time, you have lenders also, seem to be scrutinizing the insurance coverage and insurable values and everything a little more. We're kind of in a mode right now where you have, rates going up, which is one factor that determines your premium. The other one's your insurable value. So insurable value times the property insurance rate is what gives you your property insurance premium. So the market's sending rates up, and at the same time, lenders are pursuing higher values. So it's almost exponential in terms of, the cost to insure properties in many cases. I'll still say the biggest factors right now are losses. If a property has succumbed to losses over the last few years, you're assuredly looking at pretty significant increases to any assets you own. But the flip side is if you're buying a property, those sellers' loss runs are going to play a part, not only part, I mean, they're going to dictate what your insurance costs are during your ownership period on it. So it's an interesting time.
Okay, so let's talk a little bit about that, okay? Because I think that's an area that might be undervalued quite a bit, especially in this market when you're negotiating an asset, right? So those are factors that you really cannot price into your underwriting until you actually know that the property has experienced losses and you're actually requesting, right, that the loss schedule associated with that property, typically over the last 3 years or so. So in your experiences to date, okay, what are your suggestions for how operators can better price for that risk prior to even prior to even opening escrow, right? Because once you open escrow, at that point, due diligence really kicks in and starts. So can you talk about that a little bit? Because you bring up a great point.
Yeah, I do. I am preaching to my clients right now that when you put an LOI in on a property, you need to make it absolutely mandatory that the seller present to you 5 years. If they've owned it for 5 years, then you're going to need 5 years of currently valued loss runs for both the property insurance and the liability insurance portion of a property. And so what I mean by currently valued is that the losses have been generated, the loss report has been generated within like the last 30 days. And that allows your carrier, whoever we're, positioning this property to, the multiple carriers will be positioning the property to, and we can present a clear loss history to them. Now, I can tell you it is impossible in this market to get a quote without having loss runs. There was a period of time, they've always been important, but they're, back in the soft market, like I talked about, sometimes you could get a no known loss letter. Carriers would take it and move on and offer a quote. Not in this market. And so you really need the currently valued losses. So an underwriter can take a look at that property and get a mental picture of, what type of losses the property's been subject to, and they're going to base their rates upon that. And so, where I say it's so important is, people are in there trying to develop their offer on the property. And, if the property's been hit with $1 million worth of losses, I mean, you could be looking at a very substantial amount of money each year. This definitely would play into, any sort of price you might be willing to offer. And trust me, I wish there was a way around it. I hate losses more than buyers or sellers do. I wish we didn't have to deal with them, but we do.
Right.
And so they're super important.
So what are some of the common losses that you're seeing in the market that we're in today? And then what are you seeing now show up inside of these reports?
Yeah, from the property standpoint, it's the stovetop fires, that, burn 1, 2 or more units, sometimes the whole building. I mean, if they get out of control. But it's, when an underwriter looks at something, and you as a buyer should look at this too, because it gives you such a clear picture of what your tenant base looks like. You look at frequency of claims, how many claims do you have, and the severity of claims. So anybody can have one singular large claim. That can just happen, to anybody, to the best operator. But when you start seeing multiple claims over a period of time, that is what's even factored more. So, for example, if I look at a 5-year loss picture of a property and I see that they've had 3, 4 stovetop fires over the course of a 5-year period, you can only assume that's going to continue.
Right.
And even though they haven't been bad, maybe the big one's coming. That's the perspective on it. And then you transition and you look at the general liability loss runs. That covers your slip and fall type coverages, or suits, things like that. You really also kind of get a clear picture on that. I mean, and one of the big things to look out for there is assault and battery. Those are just any sorts of fights, any sort of, gun incident that happens at your property. Well, if there has been an assault and battery claim on a property, it is going to be very hard, if not impossible. It's going to be very hard to find coverage that does not exclude assault and battery for you. Now, that needs to be quantified and understood because, the largest lawsuits that I've seen from the liability side have been with assault and batteries. And so, in time and time again, we specialize. I mean, I'm sure we're going to talk about that at some point. We specialize in multifamily, so we understand where these claims come from. And I can tell you that oftentimes, it'll be once a week, if not multiple times during the week, that I will see coverage from another agent and it excludes assault and battery, and that it was just buried in a long list of exclusions and notes on their proposal and was never even talked about with the insured. Like they have no idea that they're not covered for an assault and battery. And assault and battery is $1 million claim. So, I mean, it's, most of them. I mean, obviously it depends upon the extent, but $1 million assault and battery claim is just almost commonplace, okay? And so that's why carriers have tried to exclude it. If there's been an incident, they will exclude it. And again, it kind of goes into, do I want to own this property or not? If you can't get assault and battery coverage, that's a pretty big exposure. Might be something you need to think about.
Yeah, Bryan, I really appreciate you bringing that up. Here's what's really interesting. When we're going into a market and we're making an acquisition, I've had success with, and then also I haven't had success, which is kind of interesting, but I'll share with you what we typically try to do. Is the idea is, and one of my really good friends taught me this, and he manages and owns about 3 million square feet of industrial space, right? Very smart guy. And so I'm really grateful for him. I learned a lot from him, but especially around risk management. And so one of the things that he does that I learned from is, when you're going into a market, especially if you're already there and you're making an acquisition, is to position yourself to partner with your insurance company, right?
Yeah.
But in some cases, I've had success requesting the inspection report. And of course, the insurer will say, hey, John, these are things that we've identified that need to be fixed within the next 45 to 60 days. Normally for us, they're really small items, but we've learned to embrace those things. Like, hey, I really appreciate you actually bringing these things up. Yeah, we're going to correct these. And in fact, in looking at this report, I think there's another way to be able to solve these problems and do it more effectively, but I want to run them by you first. And normally, I know for us, having those conversations have kept our rates super low. We have had almost no rate bumps in this market, which is really ironic, right? But I know why. And the reason for that is I think we're really proactive about coming back to the courier and saying, okay, hey, look, what did you find and how can we solve these issues? But there have been times where I've requested those reports and have not received them. So can you speak to that? And for me, it's mind-boggling, right? Because here I'm trying to be proactive with really understanding what those issues are, but then not being able to get the report, has been very, very frustrating for us.
Yeah, I mean, I do. I think it's always a good idea to get it. And it's funny because I would say that I would advise most clients to have the same outlook on these inspection recommendations, as we call them, as you do, because they can be a value add. Now, I will say, there's a lot that, absolutely cringe when they see the carrier go and inspect their property and they come back with, some sort of recommendation that costs money, to fix. But, they have a pretty methodical way that they walk these properties and what they look for, whether they're looking for wiring problems, in your property, issues with the panels or issues with aluminum wiring or, trip and fall hazards, loose handrails, all of those things, they're looking at it from the perspective of they're definitely trying to protect their own interest. But I can tell you it also protects your interest. Yeah, because sure. Again, it gets back to the losses. If you have a loss, you're going to be paying to some extent, if not 100% of it, you're going to be paying in terms of increased premiums. I mean, it is, we call it insurance, but it is risk financing. You're basically financing, your risk over the long term, and you need to really kind of have that perspective. The reality is there are some very legitimate claims that happen. But there are also a very large percentage of claims that are undertaken by professional claimants. And you look at like what's going on in COVID right now. Somebody lost their job. They don't know what they're going to do next. But you know what they notice? They notice that loose step or that loose handrail that's on your property.
Right.
And the next thing you know, there's a slip and a fall and a back injury and you name it. And, and it might not be immediate money for them, but 6 months or a year down the road when the thing finally settles out, there could be a big payday there for a lot of people. And you do see those things, I have clients that stay absolutely on top of everything with their property. They look at any inspection recommendation like you're talking about, and they do it and they complete it and they move on. They tend to not have losses, but it's the ones that, I don't think, this stair is fine, this handrail is fine, I don't think we need to do anything. They try to fight the inspection recommendations at every level. They generally tend to have more claims, and I mean, we look at a pretty large set of data. I mean, we insure a couple 100,000 units around the country, so we got a pretty good data set to look at. But, I can tell you just from, our limited amount that we have, I mean, you can see patterns in the data. And so I do think it's a good idea. I mean, and we do get some that are unreasonable, and we'll challenge those. But for the most part, when you see those common, hey, there's a, raised section of concrete here, somebody can stub their toe on, or there's a loose handrail, or we suggest getting the grills off the balconies. These are all common things that we see.
Right.
Yes, those are good ideas that should be taken, I think, in a positive light.
And I really appreciate, just out of curiosity, you talk about stovetop fires, okay, as something being obviously that's a really common issue. It sounds like that you deal with, because that was probably one of the first things that you brought up. And so what are ways that you've seen owners mitigate that successfully? I'm sure with extinguishers and keeping them very visible next to the stoves, but what are some other ways that you have seen people be, successful at mitigating that risk? Because it's very, very common.
Yeah, I think a lot of it, believe it or not,
small enough. Go ahead.
Sorry, stepped over you there for a minute. But, believe it or not, I think, advising your tenants in any sort of mailers, things like that, talking about it in any sort of community newsletters is always a good idea, just so it stays on their mind. Then you got like all the basic stuff of, yes, have your fire extinguishers, have a program where you're repetitively checking, your smoke detectors, if they're battery operated, not hardwired, whatever, make sure that they're, up to date. Definitely take a look at your tenant profile. I think there's always room for improvement in there. But one of the more interesting things that I've seen lately in the last year in the marketplace actually is they actually have some suppression systems. They look like little sterno cans or something that actually adhere underneath the microwave or the range top hood or whatever. And when there's heat from the stovetop, the cans burst and suppress the fire and put it out. And
hey, that's a great suggestion, Brian. That's really, really good.
Well, and there are carriers that are even offering, rebates for that. I have one in particular that basically they're going to give you a credit on the insurance premium each year that equates to the same amount as it is to buy the suppression systems. So it's not a savings the first year, but they're basically buying them for you, and then once they're in, boy, that's something great that I, as an agent can take to even future carriers down the road and say, hey, property A over here, they installed these fire suppression systems throughout the entire property, and underwriters will look at that very favorably,
right?
And so it's something good, moving forward. And but that's those are just some general guidance of what you can you can do.
Sure. What does that product typically cost? That suppression system product?
Oh gosh, I want to say it's like you want to put one for each 2 burners, so you need 2 per stove for 4 burner stove, and they're in the neighborhood of like $20-something for 2 of them, I believe.
Yeah, that's a pretty inexpensive way to prevent a fire, assuming that they work properly when you need them to.
Yeah, I mean, they've seemed to, and again, it is the most common. I placed a property a week ago, and there were 3 separate stovetop fires over a 5-year period from the seller. And, and the carrier was very much wanting to have these fire top suppression systems, put in. So this is a question that I always ask when we get into stuff like this, but one of the great things about working with insurers is they get to see the products that are working and the ones that don't, right? They're not going to use something that doesn't work and that doesn't work really well. So I'm sure they've qualified out vendors where, they go through their own test on product that works well, that doesn't have, that essentially is not breaking down, that's not faulty. So any brands out there that you've seen hold up? It was funny. There's basically one brand out there that has it pretty much has the lion's share of the market on this thing. I think it's called like Firestop. I probably should have done a look before we were sitting here on a podcast with it. But if you do any sort of look for apartment Firestop suppression, that one brand's going to pop up, and they are very predominant. And sorry, I should have the name off, but I don't right now.
That's okay. That's okay. So I guess the comment there is that a higher degree of success rate with that particular, vendor or product.
Yeah.
Okay, good. Yeah. Well, I really appreciate the comment. I think that's a great little nugget there, and likely going to save someone a couple $100,000, maybe more. Yeah. I know. We're gonna look into that. I'm gonna send my staff that after the call. So, Bryan, I'm gonna get back to a couple things that you brought up. Right. One of the initial comments was multifamily used to be a soft market when it comes to insurance. Now it's shifted a little bit to becoming more of a hard market. You elaborated on that. A couple ways to price, premiums, rate, values. So rates going up. I think the way values are being approached probably a little bit more conservatively than in the past. And then now we add on top of that the sensitivity around loss history, right, or loss runs. So underwriters are factoring these three things for habitational risk and also for liability for that matter. So can you talk a little bit about some of the changes that you're seeing with how values are being approached? Because that's a really big one, especially if you're looking at replacement, right? Or if cash value is being proposed. So can you talk a little bit about that and some of the approaches that you're seeing?
Yeah, let's just touch on basically the two ways that a loss is paid, or a loss is covered. You have replacement cost, which does not factor into depreciation. So think of it like this. You have a 10-year-old roof, the roof blows away. If it's paid at replacement cost, then you just get a new roof. And then you have actual cash value is the other way. And actual value does factor in depreciation. So you have that same 10-year-old roof. They consider that a roof's probably 20 years on average. So they're going to come in, they're going to figure out the cost for a new roof, and then they're going to pay you 50% of that because they figure 10 years of it's already been depreciated.
Right.
Fannie and Freddie and institutional type lenders do not allow an actual cash value provision in a policy. Everything has to be replacement cost, no depreciation, which is interesting because carriers now are imposing, I'm not going to say 100%, but almost any carrier that's providing a competitive rate is going to impose a 15-year provision on most architectural shingled roofs. And what I mean by that is this. They will simply say in their policy, if the roof's older than 15 years, we're going to pay you on actual cash value. We're going to factor in depreciation. But if it's younger than 15 years, we'll just replace it. And so it gets back to the acquisition of a property and how we kind of assist clients with our due diligence. Again, very common for me to have a client chasing a property. Lo and behold, it's got 20, 25-year-old roofs on it. At which point I say, hey, look, what does your lending look like on this? Oh, it's a Fannie or Freddie loan. I have this conversation with them. Okay, Fannie and Freddie's not going to allow for any sort of actual cash value provision. It has to be replacement cost, but there are no carriers in the marketplace that are going to be willing to cover a roof that's older than 15 years. So it puts buyers in the position, oftentimes, of having to replace that roof. And then becomes the next issue of, well, how quickly can you get that roof done? Because then you need to work with the lender. Does the roof get done prior to closing or immediately upon closing? And that's, that's interesting. I've seen some lenders give them 30 days, 60 days to get a roof, fixed, but, the 6-month, year out kind of time frames usually aren't acceptable. But again, it's on a lender by lender basis. So,
Sure. And that makes a lot of sense, right? Because the lender can do a holdback, and frankly, I'd prefer that because you're financing that improvement and you're capitalizing that over the life. Well, not technically the life of the loan, but you're at least amortizing that out, over, in this case, a 30-year period, which is a little bit more consistent with how that asset is going to be, or that improvement is going to be depreciated. Probably not that long, to your point about 15 years, but no, it makes total sense. Makes total sense. But so how are you seeing values right now being impacted? So you talked about, the replacement value, you talked about cash value. But in this particular market, you bring up some great points, right? We have rates being influenced or looked at a little bit differently because probably never before have we been in a situation like this. So very difficult to price this risk. And I don't think insurance companies are really going to have a good metric for doing that until we actually get through this. So we're going to be going through this for quite some time. But value is a really big one because, once the lender comes in and if there's a disagreement in how values are being derived or arrived at, which has happened to us before, how have you been able to solve that? What's the happy medium or the medium ground?
Yeah, I mean, a lot of times, the values, your lender's going to come up with an insured value on the thing, which is usually going to be based off the appraisal at some point. And the appraisal is usually going to be based off of some per square foot valuation that the appraiser came up with. If you just took your average garden style apartment somewhere in the Southeast, somewhere in the Midwest, 2-story frame standard apartment, if you went back 5 years in time, that was commonly valued at $65 a square foot. Then all of a sudden in the last few years, it kind of moved up to $70, $75 a square foot. Now, 75 is the absolute lowest in the past few months that any carrier or any lender is willing to go. But I'm also seeing carriers and lenders both start to mandate even higher per square foot values, like $85, $90 a square foot. And again, it just kind of depends upon region. And yes, we have a lot of conversations with lenders, who, I've got one this week that's wanting to put a $200 a square foot valuation on a property. We ran a Marshall and Swift report, which is an industry accepted cost determination tool. We came up with a much lower, it was a mid-rise property. It wasn't a garden style apartment, but we came up with about $120 a square foot in terms of our valuation. So that's a huge discrepancy,
right? Which
kind of all gets reflected in the premium. And we also went back to the carrier because the carriers run the same cost determinations on it that the lenders and everybody are doing. Carrier went back and said, yeah, we're totally comfortable at $125 a square foot on this. So the carrier does factor in to play on this, okay? But so we were able to go back to the lender and we were to say, hey, I understand you're saying 200. Everybody else is saying 125. Let's have a discussion about this. So when we went through the lender's appraisal, we were able to take out many things that they had included in that, such as foundations, slabs, stuff that would, for the most part, most likely be there should you have a loss and wouldn't have to be rebuilt. A lot of the site work. And as soon as they kind of took a look at that and understood what we were deducting from the values, we were able to settle out somewhere around in the 130s, range.
Yeah, Bryan, that's a great point, right? Site work, because, oftentimes, the underground improvements, the underground improvements are not netted out. That's a really, really great point. Yeah. And, when you're talking about landscaping, the reality is you don't really need landscaping to start occupying a property. Even though it will help, right? But the exterior improvements, especially landscaping, the underground improvements, that stuff is not going to go away. It's not going to burn down. Very difficult to disrupt those improvements. So yeah, that's actually a really, really good point, and I appreciate you bringing that up. Well, Bryan, we're approaching the end of our show, and man, this has been a really great conversation, especially because the markets are shifting. And I really like the way that you talked about risk today and provided some insights to our audience, especially when you have operators that are operating different portfolio, different values of assets, right? Some maybe 30 units, some 100, others thousands of units. And so the way that operators are going to assess risk, depending on how many units they're managing, going to be a little bit different. But for the most part, I think you gave a really good approach for people to start considering some of the risks associated with the portfolios that they're carrying that they may have not considered, which I think is great. So thank you for doing that. How do people get in touch with you, Bryan?
Yeah, absolutely. Email is probably the best. And, but I'll also give my phone number here to reach me. But as far as email goes, I'll say it and then I'll spell it because it's a difficult name.
Please.
But it's B Shimeall at tbmins.com, which is spelled BSHIMEALL at T as in Tom, B as in boy, M as in Mary, and the three letters INS as in insurance.com.
Awesome. I really appreciate that. And final question is, what question do you have for me that you think may add some value to our audience?
Mm-hmm. Yeah, I mean, I'd love to hear what you're seeing, what maybe some of your experiences with insurance have been, or what you're seeing in this marketplace. Kind of, I guess we can't say post-COVID, but mid-COVID here. I mean, what are you seeing from a valuation standpoint and seller's motivation? I mean, how does the marketplace feel to you right now? That's what I'd love to hear.
Okay, there are a couple of questions inside of that. So when you ask about seller motivation, are you talking about the sales side? Because you were asking me about insurance and then seller motivation. You want me to address the seller motivation first?
Yeah, do the seller motivation. Let's talk about that. Like, you seeing sellers a little more motivated in this market, or where?
So this is very interesting, right? I'm going to share something with you. So today, there was a big article inside of CoStar. Okay, this was today, talking about how the recession is actually starting to heat up, meaning, they're seeing it begin to compound, right? And they talk about two recessions. I'm not going to get into that on the call, but the point there being is what they're reflecting, which is something that I've been talking about for a couple months, which is the fact that from 2008 to 2020, January it took us 10 years to build 10 million jobs. Okay. And the first recession was in the early 1990s. The first recession was in the early 90s. Okay. The second one was, of course, 2008, 2009, right? On average, it took us 24 months to get through. We went from 50 million jobs down to 30. Okay. Now we're starting to creep back up again in terms of unemployment. But look, here's the reality. We're not going to build, and a lot of those jobs are not coming back, right? But we're not, and they speak to this in their article today, which I find it really interesting because now I think people are actually talking about this, right? We went many, many months with no one talking about the fact that it took us 10 years to create 10 million jobs, and we're not going to do that in a year. We're not going to do that in 2 years. That's just not going to happen. So I think right now, when you have market data like that, that's visible right now to sellers are going to start making decisions to liquidate assets. And if they don't, and those assets are marginally profitable, they're going to start making decisions to sell. I think a lot of your savvy sellers have already liquidated and have gotten out. But now I really believe you're going to start seeing that pick up because the data okay, this is an oxymoron. I'm going to say you can't, I was going to say the data is there, but then when you compound that on top of everything going on with COVID, it's like, okay, well, nothing really makes sense there when it comes to data, right? But the point there being is I think now that this information is starting to become more visible and you can't ignore that, right? And so consequently, sellers are going to start making decisions literally right now. Like today, I can assure you that article has triggered people to literally start putting their properties on the market, right? Start having people market that property literally today because unemployment is still ticking up. It's going to continue to tick up. It took us 24 months to get through the last one. I don't think this is going to be 24 months. I think it's going to be a little bit longer, but it's reasonable to assume that it's going to take at least 24 months when you compare this back over a historical period, right? So I think you're going to start seeing some liquidity in the market because sellers are going to start making decisions because the data is going to support the fact that there's a greater propensity for vacancy to go up.
Right.
That's my comment there. Yeah. Okay. And I think the flip side of that too is buyers are going to start seeing that data and start pricing for that. I think one of the things that I really have believed, and in fact, I sent an email to this effect to a broker that I was negotiating a deal on. it would be really, let's see, what was the summary? The summary was, I was telling the broker that we're looking at an asset, and the asset had quite a bit of very high concentration of Section 8 tenants, right? And there was also a high default rate. And when I inquired about it, I mean, it was really high. But the comment there was, I don't believe that the cost of insurance is being properly accounted for, okay, in the information that they were presenting. And I said, look, if especially with, such a low expense ratio, I said, look, if you're willing to come to terms on an expense ratio that's realistic, right, and also credit back the risk associated with that income stream and properly price the insurance, said that, yeah, I'm very open to trying to make this deal work. Unfortunately, that wasn't the case. So we both passed. But I think, and this was all the way back in April. Okay. I think in April and in May. So I really believe that you're going to start seeing more of that. Like conversations like this, very valuable, because now buyers are going to understand that you need to price your insurance differently, right? Insurance that was being priced on a per square foot basis a year, 2 years ago, 3 years ago, those metrics no longer work. You can't underwrite to 2-year data anymore on a per square foot basis. That's going to change. So you're likely going to get a lot more phone calls, Bryan, moving forward, asking for your advice on how to properly price insurance moving forward so that it could be properly accounted for in underwriting. So hopefully that answers those two questions properly.
No, it does. I mean, yeah, I get it. Nobody ever wants to talk about insurance. It's the most boring part of the deal.
Hey man, it's actually one of
you still might not want to talk about it, but it's a very important part of the deal now.
So here's what's really interesting, right? Taxes and insurance, the two typically the most expensive line items. So believe me, I want to talk about it up front all the time. Yeah. Because it's one of your more expensive line items, right? It's usually one or two, depending on the state that you're in. Yeah. And very, very important. You go down to the southern markets, and insurance is a really big line item. Yeah. You go into markets where you just don't have as much windstorm issues, then that's not as big of a line item, but still very important. So no, I agree. You're probably going to start getting a lot more calls after today's article.
Oh, we are. And hey, I called out a search while we were here on the phone. It's stovetop fire stop, or those fire suppression systems.
Stovetop fire starter stop.
It's fire stop, not fire starters. Fire stop.
Stovetop fire stop. I got it. Yeah. Well, Bryan, I really appreciate you being on and sharing your insight, your wisdom. Man, you've been really a great guest, and I'm really grateful for that. Also, really love the tips. Like I said, I think in some of the tips that you shared alone, a couple $100,000 worth of value there, as long as those items get implemented. So I really appreciate that. And can you share how our audience can get a hold of you one more time, Bryan, just to make sure folks?
Yeah, sure. Yeah, because I didn't mention my number. My phone number is 321-303-2840, and my email address is bshimeall@tbmins.com. So BSHIMEALL T as in Tom, B as in boy, M as in Mary, and the 3 letters INS as in insurance.com.
Awesome. Well, thanks so much, Bryan. Have a good one, and I wish you continued success.
You too. Take care. Thanks again.
Thanks, bud. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.